We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bob Miner. Bob has over 40 years of experience trading, is the author of one of the most popular trading books of all time, High Probability Trade Strategies, and has placed in the top 3 of several annual real money trading contests with double and triple digit annual returns over the past 35 years. He is the founder of Dynamic Traders Group, an educational and software platform for everything trading. Bob, how are you today? Thanks for joining me.
I'm fantastic. Glad to be here.
Great to have you, and I'm really looking forward to this conversation. We have a lot to get into today, from trading strategies to risk management and even election cycle studies, which you've done and written a new book on. But I'd like to start today's conversation by asking you a little bit about your background and, let's say, what got you interested in trading.
I read a book sometime in the early 1980s about trading. I don't even remember what it was. It's probably about commodities trading, because that's what we traded back then. Mm-hmm. And just did self-study for several years from the early into the mid-80s. Began writing a market report in the mid-80s called the Precious Metals Timing Report. It was about gold, silver, platinum trading. Mm-hmm. And then that kind of evolved into at the time, there were all these real estate, how to make money and zero down real estate courses with books and tapes. And I said, no one's ever written a course on commodity trading or futures trading. Mm-hmm. And so I was the first one in 1989. I released a course on futures trading where I integrated Elliott wave type of analysis and WD Gann analysis and practical trade strategies, and what today is called Fibonacci, time and price analysis. So I put those together, and that was in 1989. That was a 17-pound box of 3-ring binders and audio tapes and all of that. And then it just kind of from there progressed into more frequent reports, opening up to the broad market, and writing. I just finished the 3rd book that I've written. And I've done 2 streaming courses. One was 2008, and then one I just finished about a year and a half ago that I spent about a year putting together for practical trade strategies. So it just kept going, and it keeps getting more interesting. Every kind of cycle that we go through, bull and bear cycle, is you think you've seen it all, and then it gets a little more interesting. So I go back and restudy about a lot of cycles and trends and countertrends, and I get recharged up about what the current situation is and the probable outcome. Mm-hmm.
Well, it's interesting, over that broad of a career, that spans several decades, what do you think is the most dramatic advent into the markets? We could point to QE or low interest rates as really being a catalyst for a lot of these markets. But, from your perspective, what do you think has been one of the most, dramatic drivers of markets, and maybe something that gave you the ability to trade a market reliably?
Well, the most important thing is understanding that trends, countertrends, they're all psychological based. They're group psychology. There are cycles of optimism and pessimism, and those cycles almost always eventually go to an extreme before there's some kind of reversal that occurs. I really don't seriously look at what's the background? Why is this happening? Mm-hmm. I'm looking at the data to try to understand what's the next section going to be. Mm-hmm. And I use a lot of pattern analysis. And the thing is, patterns just represent the psychology, the group psychology, the mass psychology. And I use some terms like Gann did of buying power and selling power and that type of thing. So there isn't one thing, but it's more as time has gone on, is understanding more and more about that group psychology. I can tell you a story in a bit if you want about what I call the nephew indicator. That's really more reliable than any economic indicator that there is to understand if a market's at an extreme. But it's a psychological group process that's represented in the data.
Does that nephew indicator pick up on things like Bitcoin?
Definitely did. It definitely picked up on the 2017 peak because that's when he started to trade it. And I went home from Christmas and I said, it's about to crash. That's when that big first 80% decline occurred. And I think he's getting back into it now. So we're still a ways away. We can talk about Bitcoin. It's a really an interesting market because it's an imaginary market. It doesn't really, there's nothing really that exists, but it's pure psychology. And that's why it really is a great market for people to understand, particularly based on Elliott wave pattern type structure.
Yeah, absolutely. There's a section I'd like to get to on Bitcoin and how you see the halving that's coming, in just over 2 weeks, I guess now. But why don't we talk a little bit about how you see the difference between trading and forecasting here? Well,
they're two completely different businesses. And the one thing you totally have to realize is that forecasting is a losing game. I'm not aware of anyone that has consistently forecasted accurately the outcomes of the financial markets. There's been all kinds of studies done on this. There's books written about it, like Super Forecasters is a great book that everyone trading should read to understand that forecasting is difficult and almost all financial forecasters are incorrect in their vision of the future. However, if you want to be a forecaster, you make lots of forecasts. Eventually, you're going to be right on one, and that's what you use for your marketing for years and years. So, but forecasting sets up a psychology where you're then anticipating something to happen. And there's all these biases like confirmation bias, survivorship bias, that type of thing, that then you're only looking at information that confirms what this forecast is. So I don't do forecasts, how I term it, because I am looking for probable outcomes into the future, is in trading is that I say we identify conditions with a high probability outcome and acceptable capital exposure. So we'll be looking at a bunch of charts and I'm looking into the probable future direction and some targets. But the first thing then to identify is what can the market do that says I'm wrong? And when that occurs, then you're incorrect about the probable outcome. You want to get it out of the market. And that's a problem with people that believe in forecasts. They think, well, that's okay. It's going against me a bit. Eventually that forecast is going to be true. Unfortunately, is the market can trend against you a lot longer than your bank account can hold on. So, you have to treat trading as, you're looking into the future, but what can say that you're incorrect and you want to get out of the market immediately when that trigger is hit.
So, you used a great term, and that's that high probability trade scenario. So let's talk a little bit about your trading plan. Before entering a trade, Bob, do you identify, let's say, what your parameters are for a trade as in entry and exit positions? And is that how you manage risk within your portfolio?
Well, you have to. Yeah, you have to have a specific entry price because we're trading price. So you have to identify based on your technical analysis at exactly what price the market can hit that'll at least indicate this outcome is going to occur. And then you have to identify the specific stop. So you always know immediately when you make a trade what your capital exposure is, and not risk. Risk is the probability of an event occurring. It has nothing to do with money, but capital exposure is the amount of money that you're betting on being right. And so when you identify your entry and your stop based on whatever technical analysis you use, then it's just simple math to determine what's your position size? And whether you're trading stocks or, futures or whatever you're trading, is then you adjust your position size according to what the size of your account is. So your capital exposure is never more than what you can, have a problem with if the market moves against you.
Mhm. So then let's say, are there a handful of factors, or let's say 3 factors, that we need to have in order to exit a successful trade? Going through your work, I saw that time, price, and momentum factors are all things that you like to see converge at tops. Perhaps there's,
Mhm.
one of the charts that you sent that we can go through to illustrate one of these examples if you'd like.
Yeah, we can definitely do that. In general, it's always completely objective when you get in the trade what your capital exposure is. Then how you manage it, and that's a whole different thing. That is less objective, and that's experience and technical knowledge and that sort of thing. But what I've always tried to do, and over the years, is I try and narrow down and keep it simple, simple, simple.
Mhm.
Is that once a market reaches an extreme of the type of technical analysis, whether it's the pattern, the price, the time, the momentum cycle, is at that point that I, started adjusting that stop really close to the market. And that's pretty much regardless of what your trading plan is, what any trader will do. They'll have an idea of what is a target or what is an extreme position from where then they want to get their stop really close.
Mhm.
And then, until it reaches that position, you usually want to keep the stop pretty far away. A big problem with traders who don't have success is they panic in and out of the market. So if the market, they get some profit in a trade, is they get out too soon. And whether you read about W.D. Gann or Jesse Livermore or Bernard Baruch or all those traders from the first part of the last century, they almost all have a saying and a teaching that the big money's made in the big trend. So you want to have some approach that allows you to keep part of your position at least if the trend develops.
Mhm. So it sounds like you don't want to have, let's say, taking exogenous events like, let's say, FOMC meeting days or jobs reports into your analysis of these markets. Is that right?
Well, not exactly.
Okay.
I definitely am aware of the big 3 or 4 right now of the Fed meetings, the CPI, crop reports, and OPEC reports. I always have those on my chart.
Mhm.
Not so much that they're going to necessarily be influential in the longer term trend, but just because right around those periods, frequently, depending on the market, there are reversals in the market, but there are also 2 or 3 days of real volatility. So I want to be aware of them because I generally don't want to take a position and enter a trade plus or minus a day or so of those reports that are currently, strongly followed because of the volatility, short-term volatility. But it's the reaction after the report that is more telling than regardless of, what the numbers are that the report gives. Because
Right.
people don't always react in the way that you think they're going to react to certain report numbers.
Absolutely. It always seems like a mystery how the market is going to react one way or the other.
Mhm.
So I can understand if let's say you're setting a stop in that market when you're entering and you get stopped out just because of that short-term volatility, that doesn't necessarily mean that your analysis was wrong, right?
Absolutely. Yeah, absolutely. Yeah. You just want to avoid entering or having to stop too close around those volatile report days. That's
Mhm.
all.
So how about taking into account, what other markets are doing? Let's say, I think a classic example would be gold versus the dollar. Do you take into account, let's say, what your anticipated direction of the dollar is for your analysis on gold?
No, I don't. You can look at gold and the dollar, and in the last, big picture gold report he did, I always compare the two.
Mhm.
And the reason I compare them is that I want to show subscribers that they don't have a direct correlation. They might for 70-80% of the time, dollar down, gold up, but it can go weeks and even months of not having that correlation. So as a trader, is that I don't look at any intermarket analysis. I look at each market separately.
Mhm.
And I would look, let's say if I think there's some big change, reversal coming in the dollar, and maybe, I'm thinking that I might want to look at gold, say, I know they're related, even though they can be way off on their trends by weeks or months. But let me just take a second look at gold, type of thing. Let me take a second look at some of the commodities, because the dollar trends will affect them, even though they're not directly correlated. But basically, I just look at market individually, and that because everything else is you're interpreting.
Mhm.
You're interpreting. Is your guess going to be better than the other person's? Is your guess going to be right? I don't want that. I've been burned too many times by thinking that there's these correlations that are fixed, and when they're not, and they can be separate for weeks. Like I said, it can be correlated 80% of the time. I'm the one who's going to make the trade the 20% of the time, So I want to just focus on the market that I'm making that decision on.
Mhm. Yeah, I think that's an interesting point, because if we think about it, if we take a step back and think about, let's say, what would drive gold and the dollar to be going up together, that would typically be some type of, let's say, fear scenario, whether that would be war or any kind of event that you can kind of give as an explanation for it. But if people are running to the dollar and gold at the same time, that's going to make both of those markets go up, as you said, for a period of weeks to months sometimes, right?
Exactly. So I think all the information you need to trade a market is in that market. It's the information is there. When you start bringing this outside information is you're really guessing, and it's all just data. I mean, anybody. It's not even a thing we got to argue about. It's just all anybody has to do is bring up, 20, 30 years history of gold prices, put it right above it, 23 years, line it up with the history of dollar, and you'll see they're not always trending together. It's that simple. So a lot of people get into these arguments about what's causing what and what's going to cause what. It's like it's all irrelevant. It's pretty irrelevant anyway. It's maybe academically interesting to talk about that and make those forecasts, but my only interest in the markets is, am I going to make a profit? That's all. It's not convincing someone that I'm smarter than them, or I know what the future is, or I know what's going to cause this or that. It's just, how do I make a specific trade decision?
And kind of going back to that, to the forecasting idea, not trying to convince somebody that you have a better crystal ball, right?
Exactly. I tell everybody I don't have a crystal ball. I don't. I wish it did. In my early days, I wanted to be a forecaster because that's what I thought you did. And then I had some really good ones. Let me tell you, I've got a dentist story about that. But then I had plenty that I've hit the delete button on those reports that were not as good, and then decided that no, trading is a better opportunity.
Well, I mean, I think your record speaks for itself. When you've been trading some forex opportunities, being able to set up a system that is relatively reliable, I think, is an exceptional way to be able to analyze and look at the markets and turn a profit, right? That's, I think, what every trader wants to be able to do. And as I've said on the show, hundreds of times, we need to be able to look at these trades unemotionally so that we can divorce that, that piece of our mind from being able to analyze a market correctly, right?
Absolutely. Yep.
So why don't we get into the charts here? Bob, was there any particular one you wanted to start with?
Well, let me look down at my other monitor here. Let's start with gold.
Okay, perfect.
Yeah, we've talked a little bit about that, and I'm sure we can start with the quarterly data, and we'll just move down to a more immediate position of the market. And all of these charts I just recaptured yesterday for you. So these are all right up to date. So let's see, we got the quarterly chart up here. I'm going to be looking at a different monitor a little bit, so I won't be looking straight into the camera. But this is data that goes all the way back to 1976. There we go.
There we go, yeah.
1976. So, that first run up was the bunker or the Hunt brothers trying to corner the market. If those of you remember your history, and I was aware of it at the time when it was happening. It was just before I really got interested in what I'm doing. But then you can look at almost 20 years sideways to down into 1999. So, and then we had the next great run up, and then we had a 45% correction, and now we're in the midst of another run up. So the lesson I see from this chart is that gold is not always a great thing to hold on to long term, but it makes some nice multi-month and multi-year runs that you want to be aware of and hopefully prepared for, and also prepared for when that runs over. You can see these 70% decline, 45% decline. So that's why you want to get out of your mind. It's something, it's not an investment. It's something that has trends up and down. And right now, as we'll see that it's maybe just continuing what may be another pretty substantial run. So we're looking at this, and this is just a quarterly. So this is just some really broad sort of data. We'll look at monthly and weekly here in a minute. But based on this pattern and based on the price relationships, I developed over 30 years ago called the end of wave price target zones, and refined it over time. But we can look at this broad zone above the market. It's already reached the minimum price target, but the probable price target is around, let's just say, 2450 to 2750. So what's that? That's another $300 to $400 or $500. But keep in mind, this is a monthly chart, so that could be months away, a long time away. But certainly how I use this is that if gold were to continue to advance and eventually reach around 2450 or so, is then I'd want to be looking real close at the pattern position, the other technicals, to say, is it reaching an extreme? Because that's not necessarily going to be the final high, but it's the next point of which we would want to be very aware of what's the general position of the market and cycle position, that type of thing. So that's quite a ways above the market. So there's a saying by all the old time traders is that there's no market too high to buy as long as the trend is up, no market too low to sell as long as the trend is down. So
I think we could take NVIDIA as an example of that recently, right?
I think so. I don't really follow individual stocks, but I know what you're talking about. It's I don't know. It's going to the moon or whatever.
That chart looks ridiculous, but there's
and you want to keep in mind that the more ridiculous it looks, there's going to be a point when it's over. People are going to get hurt.
Exactly.
Yeah. So let's go to the monthly chart in gold.
If I could just ask you a quick question on this,
Sure.
Bob. Where we get to, let's say, the fifth, what would you call it? The fifth point or the fifth wave?
Fifth section, fifth wave, in Elliott wave terms. Yeah.
So is that a measured move based on the previous, let's say, 3 up or 2 up? Or is that based on, let's say, the previous cycle here?
It's based on each of those cycles where I got a 1, and a 3, and then the sub-cycles of what we call the 4, up from the 4. And when we get to the monthly, we'll look at the smaller, what we call smaller time frame targets. And what's really important is multiple time frame. That means if you're higher time frame target, which we call this our higher time frame target, based on the trends going back to 1976. And then if we go in, when we'll look at the monthly from where I got that wave 4 low, we'll look at those smaller time frame targets. When they overlap, you got a real solid target if the market reaches that. So yes, these are relationships of all the past sections within that trend. And they're specific relationships and specific ratios that make up what I call the end of wave. You can call it end of cycle, whatever you want, but target zone.
Perfect. So I think this should be, here's our monthly chart.
Yeah, that's your monthly. So again, this is just showing the data from 2015 low. And so there's, cycles within cycles, that sort of thing. It goes back to, Dow theory and before of larger waves, smaller waves, the tide coming in and the small waves coming in. And that's what Elliott wave is based on is multiple time frames, how you break down each section. So we break down the section from the December 2015 low. Again, it's just like textbook stuff. I'm waiting for something to go wrong because this is too perfect. But the typical outcome, the probable outcome, would be for the section up from 2015. The typical target would be, I have to get down and look at this, about 2,600 to 2,700. So now we have about $100 range that's within that broader range we were looking at in the quarterly data. So it's a pretty strong price zone if gold should reach that. And typically, based on this pattern and this type of cycle, it would reach at least that minimum target around 2,600. So again, there's probably quite a bit on the upside for gold. And again, if it reaches that, then we got to be taking a close look at the market to see if it looks like it's in final stages.
So once we get to that, close to that target, that's when you start looking at the momentum. And what other indicators are you looking at?
Well, I have my own momentum cycle indicator that I use, and I just didn't put it on these charts because then we get into a whole nother technical sort of thing. But I use those for entry position, and then also if we reach these extremes to see if it's in a position to complete this trend. So one thing about the language I want to note, how you mentioned that you said once we get there, we don't know if it's going to get there. So if it should reach that target, that's when we then want to look at potential exit strategies or bringing a stop up closer. Right now on this chart, you can see that red line, horizontal line, across the February low. And this is the point, if by chance gold should decline below that level, then this outlook for it to go higher is completely off the books. And what would be really important if this happens is that we've had this breakout. We can see in the chart the breakout of this basically a triple top, which is a newsworthy event and which is fairly significant. What we call a breakout failure, if that should happen. Again, I don't know if it's going to happen, but if it's a failure and it comes back and takes out that swing low, well, you don't want to be in the market because that would be a false breakout and would probably be followed by capitulation. Because the people that are entering the market and have over the last few weeks and months, if they're leveraged, once they get below that level, they're going to be getting calls from their brokers.
Yeah, and I think that's another important point when some of these, let's say some of these trades go against people. Even, I did an interview the other day about understanding where the short positions are. and how that can drive price higher at times too when they have to buy these short positions back to cover them. So it's interesting how that, how that market behavior really can act in to drive markets both higher and lower.
Exactly. Yeah, realizing that most people are leveraged and most people can't handle a market moving against them. So that's why a lot of these fast moves are made up and down, is that particularly if they're leveraged and it takes out around the area from where a large amount of people have entered the market, is they got to get out fast. And that accelerates the trend, and selling begets selling, buying begets buying. So for instance, if we just look at this chart on gold, if gold continues higher, it's a newsworthy event. And then most people participate in the market in the final stages. So then, and that's my nephew signal, is that when my nephew is making money, I know it's time to get out because he's in the later stages in the blow-off phase. But there can be a lot of buying coming into the market in that final stage, and that final stage can last a lot longer than you think it is. But you really need to recognize this is the final stage. I need to be thinking about that.
So let's go to the weekly data now.
Right. So here we look in a little bit closer to the immediate position coming off of this October 2022 low. And the main message from this chart is that we don't need to go into details, I guess, about the pattern analysis, but this is an unfulfilled pattern on the upside, and that more than likely it has quite a ways to go. But once again, you have to identify what could the market say that would indicate that's not going to be the case. And now we're down a weekly close on the nearest futures contract below the week ending January 26 close. In this case, it's at 2017.30, would void this outlook for a continued bull trend. So that's not very far from the market. So if we look at that target on the upside, it's $300 or more away. And that's just a typical target. Who knows, could go further. And the difference between the current position in 2017, there's quite a bit of room potentially on the upside, reasonably close stop to get out of the market. So just imagine, as we've had that low represents several weeks of basically sideways action, what we call correction, before it broke out to a new high. If this market should decline below that low, it's also getting below that triple top. There'll be a lot of liquidation that would happen, I suspect anyway. I mean, I'm going to be out if we get a weekly close below 2017.
Yeah, absolutely. And I think, going back to the trend lines that were on the monthly chart or the quarterly chart, that would, also kind of signal that break in that trend, right?
Right. Yeah.
Perfect. Let's go dollar now. So I'm on dollar. I think this is quarterly.
Yeah, this is quarter. This is a very long-term one, just to get a perspective. And the message here is that this dollar, again, it was so textbook, going into that September 2022 high. I mean, it just hit some time and price targets to complete the bull trend off of the 2008 low. So this was a major bull trend that is probably complete. What does that mean? Well, that means that more than likely the dollar is going to be sideways to down or net bearish, not just a few weeks, a few months, but probably for a few years. And that's pretty significant for not just for traders, but for people whose businesses are affected by the value of the dollar. Knowing that, well, we never know, but at least if we look at the odds are, the probable is that the dollar will be sideways to down for 2 or 3 years. That could make a big difference in business decisions that people might make.
Yeah, absolutely.
So what I have below there before we go to the monthly is just, you can see around the bottom of the chart, I've only put a couple of time factors on here. The most significant one is that March 2028 low. And just as markets have price retracements, they have time retracements. And so the 38% time retracement is not until early 2028. And that's typically the minimum retracement to a major trend, five-wave trend that we're showing here. So that would indicate more than likely the dollar is going to be net bearish into March of 2028 or beyond. So, that's a few years away. So that's fairly significant. Yeah. And what this means is you might want to take a look at the euro for a long-term positive trade.
Interesting. So let's go to the monthly now. And I have some other questions based on, let's say, the comparison of these Forex markets.
Sure. Well, this is a dollar monthly, and it's just focusing in on the relatively recent data. This is from the 2017 high. And again, the message here is that September probably completed this multi-year high. We've had the first leg down and the first correction, which is that little labeled the wave 2, and that more than likely in the weeks ahead, the dollar will continue to its bear trend to decline well below the 2023 low. And I have highlighted there that horizontal line, the green line, which is the October 2023 high. If the dollar should trade above that, is that then this bearish outcome is questionable. So it wouldn't be totally voided, but I wrote on there, it voids the probable bearish outcome. I would say it'd be questionable, really only would void it if it took out that September 2022 high. But because of some other time and price and momentum cycle factors, I don't think it should take out the October high. So again, before too long, the dollar is likely to continue that bear trend to a new low.
Excellent. So then let's move on from there into what that means for yields.
Well, I don't know what that means for yields, but I can tell you what I think the position and outcome of yields is going to be. Again, this is the 10-year yields. It's the weekly data, the close-only data from the 2020 low. And of course, we just had this relentless bull trend in yields from the 2020 low into the October 2023 high. And look at how perfect this, 5 sections are going up in this. I mean, and then I've got a couple of the price factors in here that I had in on these charts for many, many weeks. And it overshot it slightly, but it got into that position from where the final section is typically complete. And if that's the case, then yields should be net bearish, meaning, that we're going to be seeing a little bit lower yields, and not necessarily quickly, but for the next year and a half or more, at least into 2025. Again, that's the minimum time target for yields to be net bearish. And this is such a beautiful chart, and it all kind of makes sense. I think we're all aware that the Fed or whoever is going to hopefully be reducing interest rates over time. This just shows us that indeed in October 23, yields hit, I would call it a structural point from where they probably peaked for, in this case, could be 2 to 3 years. So how that's going to affect the other markets, I'm not really sure, but I would say we're yields are kind of at the highest level they're going to be for a couple of years, more than likely.
Yeah, and it's interesting to be able to look at, let's say, that peak and then the pullback that wasn't necessarily driven by the Fed, but it was the markets that drove that actual behavior rather than the Fed actually adjusting.
Absolutely. I mean, people have written over and over again that the Fed just reacts to markets. They don't create it. So, and unfortunately, they tend to react too late. But that's why I just like to focus on the chart and not all this nonsense about the Fed. I don't know what they're going to do. But you know, all of these markets are driven by individuals and their psychology, their outlook for the future. And the Fed and the government organizations react to that. And usually they're slow to react. And then typically they overreact. So, just like holding interest rates down at, 3% or less for way too long, was not a good thing in retrospect. But I focus on the charts. The chart is clearly indicating to me that the interest rates are going to be sideways to down, probably at least into 2025. So you can use that information in different ways. Like, might be a time to instead of having a money savings account, get a CD, lock it in for a year or two, that type of thing.
Interesting. So let's move on to our crude charts here now. This is obviously, tied fairly closely to inflation as a raw input cost, but how are you reading this chart, Bob?
Oh, this is another chart that seems to me pretty clear, and it's been, for many months, it's been responding to the types of ways I look at the market. So this is a monthly chart. It's going all the way back to 2008. And it's basically showing into the March 2022 low. We probably completed another 5-section bull trend. And more than likely, this correction off of the March, I think I said March 2022 low, I meant the high. More than likely, this correction is not complete. It has some time to go. And for me, as I wrote in my newsletter and have a few times in recent months, because more than likely I'm looking at this market as being bearish and probably will reach around 50 or less even dollars. That's hard to wrap your head around given the geopolitical situation in the world today. And what's going on in the Mideast with both transportation and war type stuff. But I got to look at the chart and I say more than likely crude's going to be lower in the months and over the next year or so. So that's why I try to avoid letting the news influence that decision. And while I try to identify then what the market can do to say I'm wrong.
Yeah, I mean, I've heard it explained several ways. The chart does what it does, and then there is some explanation put on top of it as, as a catalyst or however you want to call it, that explains that price pattern. If we do see a major, let's say, global slowdown in demand, like a global recession, that could very well explain oil prices going lower, right?
Correct. There's always an explanation after the fact. And sometimes it's a unique explanation. It's very interesting to try to figure out those dynamics because sometimes the outcome is not at all what was expected, and that some influence, some input actually worked in a different way because of all the other inputs and influences that you put all those together, and all of a sudden the outcome is a little bit different than maybe it's been in the past because you weren't taking into consideration all of the influences. Sometimes we get focused too much on one direct influence, one correlation, and then we miss what's going on outside of that correlation.
Well, as many of these interviews as I've done, and I have guests that take, let's say, 20 or 30 different things into consideration. It always makes me kind of come back to question how you're taking all of the right pieces of data into account for that analysis, rather than, and for myself, just trying to understand to step back and say, what is the most accurate way to do this, whether it's just looking at the chart or, looking at 30 plus different pieces of data to make sure you didn't miss anything, right?
Yeah. It's really hard if you're looking at 30 pieces of data, even 3 or 4, how they're going to interact together. Mm-hmm. Kind of an interesting story for you. Back in 2007 is I lived in Colorado at the time, and most of my friends were in real estate. They were construction, they were mortgage brokers, they were real estate agents. And back in the early 80s, before I started doing what I was doing, I was a real estate agent in Tucson, Arizona. So I hung my license when the 30-year FHA mortgage was 16%. Wow. So I'm kind of, that's why people whine about 7%. I'm going, what's that? That's nothing. Come on, But, there was this crazy speculative blow-off. Well, we didn't know it was a blow-off at the time, or I suspected it was in real estate. And I started talking to, my real estate friends or brokers particularly. And I said, how are you making loans to some of these people? They can't pay them back. Adjustable rate loans, and that sort of thing. Said, oh, we know that. We know they're never going to pay them back. But the mortgage company, the bank, allows us to make them for, whatever reason. So how does a mortgage broker make money? They make money by making loans. Mm-hmm. So they're going to continue making loans, and substantial number of them, to people that will never be able to pay them back. So I thought, at some point in time, once they stop paying back, the market's going to have a big problem. That was pretty logical, looking at just one thing from my experience. In July 2007, I wrote a special report for subscribers that said that we're getting pretty close to probably a real estate bear market. The first one, actually, in our history, that will be more than a 10% correction. I had the real estate data going back to the 1800s. Mm-hmm. And real estate usually does not decline in value in recessions. It usually just goes flat, maybe 10%. But I wrote, I think we're going to have a decline in most regions of 30 to 40%, because this is a completely unique situation from any time else in history. Mm-hmm. And that's one of my better forecasts. I got some others that didn't work out as well, but that was just something pretty logical that most people, they could think about what's happening, and is it sustainable, mm-hmm. sort of thing. So when something doesn't seem sustainable, then you want to take a look at, the data, the charts or whatever, and say, what's going on here, mm-hmm. and how's it going to end? So anyway, we'll get back to that's another one of my war stories from. Mm-hmm.
Yeah, it seems like a reset was imminent for that entire market.
Absolutely. There's just no question that all these homes are going to get defaulted on. So mm-hmm. Anywho.
So let's go back to crude here. This is weekly data.
Yeah, this is weekly. And this is another way to look at a chart. So the outlook on that monthly chart was for a probable continuation of a bear trend to a new low. So a couple things in this chart. Number one, if crude were to advance above that September 23 high, then the basis for that outlook is voided and something else is going on. So that's not too far from where the market is right now, if that should happen. Mm-hmm. And if that should happen, I would, change that probably outlook position of the market. And as my friend Maynard Holt used to say, in the 90s, when a market doesn't do what it's supposed to do, it's probably going to do just the opposite in a big way. So if crude were to continue above that, this outlook for lower prices would be voided. The other thing to look at is coming off of that December 23 low. This is another way to kind of look at a chart that can be helpful, is that decline from September 23 high into the December low. That was a 10-week decline. So here we are this past week, we're 16 weeks, and that market is just barely struggling up over 16 weeks, hasn't even reached the 62% retracement. This looks to me, if I were just looking at that data, I said this market having a problem, it's about to roll over. So that's more a judgment making from experience. But this is not what we call an impulsive trend coming off the December low. It looks very much like a correction. And when a correction is complete, what happens? The trend prior to the correction continues to a new extreme. So, and that's where 90% of my trades are, is identifying the end of a correction. Because when that correction is complete, then the higher time frame trend continues to a new extreme. So that's a simple way to look at the market that can set you up for some great trades. But that doesn't look like a healthy market to me over these last few months. Looks like a market that's having a problem.
Bob, do you tend to short markets that you see entering a correction, or do you only try to go long in markets?
No, short or long.
Okay. Perfect.
Yeah, both. Yeah.
So this is a chart looking into this one for basically inflation, commodity inflation, right?
Yes. I think this particular index does not include oil. Crude.
Okay. Mm-hmm.
Mm-hmm. Yeah, I only look at this now and then in my report, and I looked at it again because you mentioned commodities. Commodity wise, I'm always looking at beans just because it's one of the first markets I traded back in the 80s. Soybeans and of course crude, but I don't look at a lot of the other commodities now. But this index is also indicating that more than likely it's about to roll over to the downside. So it had this really sharp advance off of the 2020 low, and more than likely it has not finished this correction off that advance. Mm-hmm. And so I look at this like it's about to finish a little ABC correction. We call it a higher time frame wave B, and when that's complete, which could be 2 or 3 months from now, these are monthly data, then it would roll over and continue to below the May 2023 low. Mm-hmm. So, and in other words, this is kind of telling us, probably temporarily anyway, we've had a high in inflation. It's going to be sideways to down, probably for another year or two. Mm-hmm.
One of the other markets that we can look at here is the URA, or uranium, right? So let's start with the monthly here.
Yeah, take a look at the monthly. And I never really looked at this until earlier in the year. One of my subscribers says, what about uranium? I'm going, I don't know anything about uranium, but I can look at any chart mm-hmm. and give you an opinion, basically. So earlier in the year, and the reason it was brought to my attention, it had been in this basically prolonged trading range for many months after having this, well-defined 5-wave trend into the November 2021 high. So the objective was to identify when the market would be in a position to complete this correction. And I called it pretty close to that within a few weeks anyway in the newsletter. And then because it's not a regular market I follow, I just had that in as a special situation. You might want to look at this. If this correction is complete, then it should eventually continue to a new high. And then I looked at it again a few weeks ago, and it was like, well, it's pretty close to this 5-wave trend. And when that's finished, then it should have a multi-month correction before it continues that trend. And I think that's where we're at now. This might be a market, and this is an ETF. So, you can just, you can trade anything within ETFs as long as they got some good volume. Mm-hmm. But this might be one that people listening might want to put on the radar to take a look at, probably 2 or 3 months from now, when it's in a position to completing this correction. Mm-hmm.
So then here's the weekly chart to look at it a different way.
Yeah, that's just looking at it. We're focusing in a little more on it, on the weekly closing data. And again, it shows this advance off of the, March 2023 low. Nice 5-wave impulse trend. More than likely, this correction will continue sometime between into late May to the middle of August. So we get in the middle of May, which is not that far away, another 6 weeks or so, I'll be looking at this market to see if it continues sideways to down, that we would be getting near a position to where corrections are typically complete. Because, I mean, this is a nice impulsive advance that occurred earlier in the year. And more than likely, if the market's making a correction, as it seems to be, once that correction is finished, should have another good run up. And of course, if it makes a new high, it's a newsworthy event, more buying comes in the market. So I'm going to be looking real closely at this uranium ETF beginning around mid-May or so. So sometime between mid-May and mid-August, I suspect uranium will complete a correction before it continues this advance.
Mm-hmm. So, taking into consideration, you have, I believe they're moving averages on the bottom, right?
No, that's not moving averages. That's the DT oscillator that I developed 20 plus years ago. It's basically what's called a stochastic. It's a momentum indicator. All momentum indicators give you about the same information.
So when we get that cross again, like we see the last two green boxes there, when we get that cross, that's another indicator of things kind of peaking probable, let's say to the probable side, back bullish, right?
Correct. Correct. Yeah, it's definitely a time you want to wake up and say that more than likely, in this case, because this is weekly data, it's in a position to make a multi-week or a multi-month low. Mm-hmm. And all momentum indicators are most valuable to help identify the end of correction. So as you can see on this chart, there's a long, through most of this bull trend, it was what we call overbought, and having that red up there. So the momentum cycle is most valuable to help identify when a correction is complete, and then the higher time frame trend is going to continue. Mm-hmm. And this is basically, you can use a stochastic, almost any momentum indicator is the same.
Mm-hmm. So Bob, I wanted to talk to you a little bit as well about your new book, but the study you've been doing for a long time. So you're the author of The Definitive Guide to the U.S. Election Cycle and Stock Market Trends, which, as you say, is one of the most consistent cycles in the U.S. economy. So how long ago did you start trying to analyze this cycle, and how does it affect the markets?
Well, I first started writing about it in the late 90s. I actually still have some of the printed booklets that I wrote about the election cycle and stock market trends. So I've been looking at it on and off for, we're pushing 25 years or so. And periodically, I would then do reports for, my subscribers in the newsletter. And what I did was this beginning of last year, actually, I ended up doing this real comprehensive report for subscribers on the pre-election year cycle. Mm-hmm. And I decided, I can turn this into a book, and I can do each of the years. And one of the reasons is that there's so much misinformation. And I don't want to call it misinformation, but incomplete information about stock market trends in the election cycle. So this is actually the only book out there that's just about that I'm aware of anyway. Mm-hmm. And I try to cut through kind of the misinformation in that you really don't want to just look at averages. You have to look at how that data is dispersed and distributed, and focus in on the really strongly biased position. And I've come up with some sort of unique also types of trades within each of the election years.
Mm-hmm. Yeah. The book includes chapters on election cycles, post-election years, midterm elections, the sweet spot, what you call close to a sure thing in a trade, and also election cycle trade examples. And you update it, or you have updated it for this new election cycle, right?
Yes. In fact, one of the tables that's updated, we can also take a look at here in a minute. And as well as I think I have the trend up through last week and how it relates to. Let's look at the other chart I sent you and said this table first. That one, yeah. So I update this every month for our subscribers, and the book is just out. So all of the data and trends and the seasonal trends and potential trade setups are in the book.
Mhm.
But this is I think really interesting. This is a great chart. Is that these are the average trends for all election years going back to 1952. So there's four average trends that I have in this chart. One is for all of the election years since 1952, all of those election years of which the president was in their first term, which is this year, and all of those years of which the president was a Democrat or a first-term president. So what's interesting about this is number one, those election years with a Democratic president far outperform the average. And those years with their first term Democratic president even outperform all of however you want to mix the averages up. So what this basically tells us is that we want to look kind of closely at this year, because particularly around the second half of the year, or the middle part of the year, all of these averages, however we divide them up, looks like it has a pretty strong bull trend for that period of time. Now, keep in mind, any average, there can be a wide dispersion. It doesn't mean every year is up. There can be a lot of volatility. And that's why then we break the data down to get a little better look at what to anticipate based on history. And the other thing is really, really important is that seasonal trends and these type of trends, this is really a seasonal type of study, is that no matter what the average is, it does not project what the next data point will be. So it projects, over the next 50 years, this will probably be the average, but not the next data point.
Right.
And so we have to have a strategy that, again, it's like a stop. It'll get us out of the market if the average doesn't continue, or if the current period doesn't continue as the averages have. So that table I've got for you, this is something that your listeners can use this year. So what this table shows is for each of these months low, the March, April, May, and June, what the percentage gain was into the summer high. So it's better than looking at the average, because we know there's an average. And by the way, there's only 1 year when there's been a loss from the summer low to the spring low to the summer high. So it's a real reliable trend, but there's a lot of volatility between it. But look at this data. The March low is that the March low has never been exceeded since 1952 in an election. It hasn't been exceeded, but the summer high has always been above the March low since 1952. Now that's a real practical piece of information, because we now know, we'll know in a few days, what the March low is. So it's not forecasting what's going to happen, but if by chance the S&P at some point in the weeks and next couple, 3 months were to decline below the March low, at least since 1952, by the end of summer, it's above that low. So it's giving us a strong confirmation that sometime from around springtime, between the end of March into early June, that's a broad period of springtime, there's a very consistent bull trend. And sometimes it's very mild, it's a few percent, sometimes it's pretty good, into the summer, the end of summer, which would take us into September. So we use our technical analysis to indicate when we get into that period of spring to identify a probable go-long strategy. And it can be very helpful to know that because I believe the stock market is in a position for a fairly substantial correction.
Mhm.
If the market were down below the March low, that more than likely by mid to end of summer, it's going to be above that March low. So it's telling us more than likely we don't have any significant bear trend coming up between now and the end of the year. And we can take advantage of this data for a specific trade strategy.
Yeah, it's interesting as well. Like you pointed out, the 1 year it was actually down was 2008. But it's also interesting to look at 1980 and 2020 to see the gains that were made in there. Let's say 28% from the March low to the September high in 1980, and 60% from the March low to the September high in 2020. So those, those outlier years stay consistent with that trend, and that's quite interesting to be able to see.
Yeah, it really is, and that there's been a lot of bear market years that have had not just election years in this particular season, but other years within the cycle, that the year has not been good, but there's particular periods within the year that had a real strong bias, a positive bias. And those usually then represented periods that were corrections within a bear trend. So we want to be aware of those because the market can have a really significant correction or continuation of the trend.
Absolutely. Was there anything else that you wanted to go over based around the book, Bob?
Not particularly. This is actually this period around now, between now and really the end of May into the mid to late summer. That's the strongest biased period within an election year. There's a short period near the end of the year, that kind of fall to winter rally, that's also highly biased. It's a much shorter period of time. But this is one of the best setups within an election year, would be coming up here probably in the next few weeks. So that's the best I got to give you right now with the election year data. And one of the things that if someone trades the stock market and they're particularly interested in stock market trends, I think you'll find the book really valuable because I include a chart for every single year, for each, whether it's election year, pre-election year, post-election year, et cetera, so that you have that reference to go back and see, well, it's not really consistent, but between this period and this period, it's usually a net advance, that type of thing. So I think it's a really great resource for anyone who's going to trade the stock market.
Absolutely. And like we say, you go into great depth in the book, analyzing, showing examples, and then showing even midterm election years, and really analyzing the entire process.
Yep.
Bob, one of the other pieces that I wanted to talk to you about was the 16-page report that you've written about Bitcoin and what you think is going to happen around the halving around mid-April here. So what do you think investors need to take into consideration surrounding this year?
Well, there's, of course, there's only 3 data points for what's happened around halvings. So we have a very limited number of cycles and data points. But for all the past 3 halvings, following the halving, Bitcoin has been sideways to down for 4 to 6 weeks. So everybody thinks, this is the halving, there's going to be more demand or less supply and the market's going to take off. Well, it tends to do just the opposite temporarily. But then following that 4 to 6 week period, another bull section usually gets underway. And of course, we know with Bitcoin, bull market is not 20, 30%. It's, can be 100%, 200%, because it's really psychologically based, panicked in, panicked out. So I would be, particularly now that there's ETFs for Bitcoin, is that I would be really alert around the middle of May, middle of May to the end of May, to the technical position of the market. And I'm looking at Bitcoin now as it's in probably the early stages of a multi-week to multi-month correction. And that would actually be the ideal setup. into around the middle to the end of May than to identify if it should be sideways to down into that period, is that to identify an opportunity to be long. Because this is also potentially will be a fifth wave advance because we've had this beautiful three-wave advance right into the recent high. And if we get that correction that lasts a few weeks to a few months, that's going to be a real opportunity. More than likely, that correction won't be complete until around mid-May or so.
Okay. So again, like somewhat of a textbook advance as we looked at the one for the dollar and also for gold, right?
Right. Probably a textbook impulsive advance. And if that happens, if it gets set up like that, and the reason it's really interesting and is that it would take Bitcoin to new highs, and it'll be all over the news and YouTube and Twitter and every place else. And there could be some real speculative buying that comes into the market to push that market up. So that's what makes it interesting, very interesting to me. Technically, if it's set up in that way going into May, it could be significant opportunity.
And as you said, to to understand, things from the nephew indicator, especially in Bitcoin, how that psychology of, let's say, speculators going into that market, not wanting to miss out or FOMOing into that market, I think really helps drive a lot of that volatility, right?
Oh, absolutely. I mean, Bitcoin is the most purely psychologically driven market. It's not a currency. It has no fundamental use or value. It's purely cycles of optimism and pessimism, and panic buying into it, the fear of missing out, can really drive a market. And given that it's near all-time highs, and if it does that breakout, we could see just an incredible trend happen. Something that is totally illogical. Nothing that has any fundamental value goes up 200% and down 80%, up 100% down. But if it's getting set up for another one of those up runs, why not take advantage of that? It's a liquid market.
And especially if you can understand and set the parameters for that trade.
Yes, yeah, you got to. It's just a technical position like any other trade. You got to ignore all this stuff and the future of Bitcoin and finance. That's all nonsense. Just look at that chart and see when it starts to take off. And you really want to get in there early on, relatively early on. Of course, that's the dream of any trade. But a trade that has this potential to be some speculative run to significant new highs is that it's really important to get on relatively early, because when it is over, again, it's 70-80% decline really fast.
Excellent, Bob. Well, that's all the questions I have for you today. Is there anything else that you'd like to add before we wrap up here?
No, I guess my kind of motto is don't forecast, learn to trade. And look at a market as not trying to be right or wrong or understanding the politics of the world or the finances. Look at it as, how am I going to make some money off this, and learn trade strategies. And that's what I do.
Yeah, I think a perfect example of that is how you look at Bitcoin. It's not necessarily something that you have to buy into, mentally, whether you love the market or not, whether you believe in it as a currency or the future or not. You're looking at it as purely from a monetary trade of time standpoint. And I think that we can all learn from divorcing, let's say, that fever from, whether it's from all markets, not just the Bitcoin market, not just the gold market, but all of these markets, because that, I think, ultimately is how you end up making money, even in whether it's, gold miners, Bitcoin, whatever it's going to be, right?
Absolutely. You're correct.
Of course, all of Bob's books are available on Amazon, print, Kindle, and I believe Audible as well, right?
No, they're not Audible. Too many
Okay.
charts and tables to do it as an Audible book. Mhm.
Excellent. And of course, all your work all available at dynamictraders.com. And of course, your great Twitter follow as well at Bob at DT.
Mhm.
We'll have all of that in the show notes. Bob, thanks so much for your time today. Really appreciate you going through in depth a lot of these charts and your process with us today.
You betcha. Thanks for having me. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.